All right, where can you actually earn a predictable 10% yield paid monthly without gambling on the wrong operator? That's the question that I kept running into this year as I started diversifying my $1.7 million debt portfolio. So if you've been sitting on capital and comparing private credit or income funds, you've probably noticed the same thing that I have, which is that every fund promises safe returns, but when you dig in deeper, the details couldn't be more different. Some take second position loans, others don't have audited financials, some are small $5 million boutique shops, others manage billions and send institutional grade reporting. So instead of guessing, I decided to map the landscape out. And over the last 3 months, I've interviewed more than 75 private real estate debt funds with at least a 1-hour conversation each, with every single detail logged after asking over 30 different questions. Everything from structure, leverage, redemption terms, what is the profit split, and patterns started to appear that I think most investors never see. And so in today's solo episode of the Passive Income Playbook, I'm going to be breaking down what I found and what it means if you are deploying capital into these types of debt funds this year. So in this episode, you're going to learn what's really happening across the private fund landscape and why a 10% return can really mean 10 different things. I'm going to share with you surprising insights that I've had from over, 75 of these hour-long calls. And, I can talk about the metrics that separate the good ones from the average ones. I will talk about what I think some of the biggest blind spots are that people don't ask for that I came across. And then ultimately how you can get access and find a lot of these funds yourself. Now, before I dive in, if you're new here, or if you're new to the show, or if you're new to me, I'm Pascal Wagner, and I started my career in venture capital at Techstars in 2019, where I learned how to basically invest in companies at an institutional level. There I was in charge of managing. Techstars had just raised a $150 million fund, and the chief investment officer had kind of like set the strategy or the thesis for what types of companies we should be investing in. And my job was to figure out who all those companies were that matched that criteria, and then ultimately execute on the investment. And so, during my time there, specifically at Techstars, I was responsible for deploying over $150 million over 3 years into over 300 different companies, with the minimum check size being at least $150,000, all the way up to, I think we did 2 million in the largest case. And so that's kind of like my institutional investing experience. And while I was working at Techstars, in 2021, my dad had passed away. And then I all of a sudden became the de facto chief investment officer for the family. My mom, didn't know anything about money. My dad was the one who always handled the finances. And so, as someone who worked at a debt who worked at an institutional fund, I'm pretty savvy with investments, I took it over. And I did all the things that they tell you to do. I went to financial advisors. I asked them, where should I be investing? And you soon realize that they're highly incentivized just to have your money in the market or in a vehicle that they earn a commission off of. And I had worked at a venture capital fund and where people trusted us to deploy capital on their behalf. And I understood the concept that we were much better at deploying capital than probably the people who are giving us the money. And so I was familiar with this idea of investing in other funds. And without going into too much detail here, maybe I'll save that for another episode. But since then, I have personally deployed over $3.3 million across 23 different private deals. I've written off over $500,000 in taxes and have built a portfolio that generates over $100,000 a year for our family from those private investments. And so my lens has always been simple when it comes at least to this area of managing our portfolio, which is how can I orient a portion of my portfolio to provide consistent cash flow that we can live off of every month. And so that's a little bit about me. Before I really dive into how I got into this research project, I just want to take a moment and say, if you have considered going to the Best Ever CRE conference, we are hosting the 10th Best Ever conference this upcoming year in 2026. And if you're an LPGP or just serious about growing your passive investment portfolio, you're not going to want to miss it. We're going to be in Salt Lake City from February 18th to the 20th in 2026. And I will actually be teaching a workshop there as part of one of the paid events. And so if you'd like to attend that, or if you just want to learn a little bit more about passive investing, I highly encourage you go. The tickets are still, I believe, still under $700. So if that's interesting to you, go check it out at besteverconference.com, and I'll see you there. But okay, so now let's dive in. So what prompted me to start this research project? So maybe the way to think about this is I give you an outline of where my portfolio has been and what led me to even start doing this research. So look, when I started passive investing, my goal was pretty simple, right? Like all of a sudden, my dad had passed away. There was a big chunk of money, and my mom was spending. She just was living her life, and between healthcare and rent and groceries and just what it costs to live, we were spending over $100,000 a year, and so. When $8,000 is coming out of the account every month, you are highly incentivized to start repositioning the capital so that it's at least earning something. And back then in 2021, I don't know if you can remember, but there was a lot of craziness happening. COVID, we're on the back half of COVID. Cities were opening back up, and inflation was through the roof. And, we weren't sure if inflation was 8%, if it was 10%, maybe it would continue going higher. It didn't feel like things were under control. And so, I had invested a good chunk of the capital that my mom inherited into a strategy that I knew how to generate cash flow, which is I buy single family homes and I rent them by the room. So most people think of this as, or have heard of this called house hacking or co-living. I basically take a 3 or 4 bedroom place and I'll turn it into 7 or 8 bedrooms and rent it out by the room. And people can go online on a platform called Pad Split, and they check for the room, and then they can book it online just like an Airbnb and walk in. And so I had a huge chunk of our capital, over $3 million in this one strategy in Atlanta. I have over 104 units at the time across 12 properties. And I realized that if I had one hurricane come through our portfolio in Atlanta, that basically all the cash flow that was there to support my family, myself, and my mom would be wiped out. And so I took a step back and I realized, okay, where can I start deploying this money so that I can maybe earn 10% off of it and I can start having cash flow at least come in while I'm waiting to and doing research and figuring out where I should deploy the capital. And so after reaching out to a bunch of different people in my network, like GoBundance, I realized that I wanted to invest with big institutional operators. I know that in the private investment world, the smaller that you go, the more risk that there is. The rule number one that you always hear from the greats like Warren Buffett or Charlie Munger is don't lose money. And so my take was, let me go where all the teachers' pension funds and the firefighter associations and the Yale endowment, all of those types of big entities. Where do they invest? And let me follow them. People who can't lose money. So ultimately, I went through all my groups. I got a bunch of different recommendations, and I'll spare you the details there, but I ended up investing in what I have are 4 different debt funds. So some of them you might be familiar with, and one I guarantee you won't. But I ended up investing $1.7 million into across the DLP Capital Lending Fund, the DLP Capital Preferred Credit Fund, the Polaris Fund by Polaris Capital Group, which is a cannabis mortgage fund, and then Cash Geeks, which does transactional funding. So when you think of wholesalers who go and buy and maybe double sell or double close on a home, those people need money to transact in cash. And so one of my friends' little brother, I've been lending money to for a while to do that. So I'll dig into that in a second. But I think the point here is that each of these paid consistent monthly income, and I've actually been really happy with how it's turned out. I've been in these funds for, I think, a little over 2 years, 3 years in some cases. And I think my biggest takeaway investing as an LP has been that when you if you're looking for consistent monthly cash flow, that debt funds and private credit funds are the place to do it. They provide cash flow within 45 days. You can take your money out relatively easy, within a 3-month time frame. You don't have instant liquidity, but it's liquid enough for me. Ultimately, I just wanted a safe place to put my money. You're going to hear me say that a lot. I wanted a safe place, and a lot of these firms had audited financials and were big firms. So, one other thing I think I would mention here is that as I invested in these funds, I've realized that I've made a lot of money in the past through having basically high conviction, highly concentrated bets. I invested in Tesla with $100,000 10 years ago, and that turned into 1.5 million today. And then I invested in crypto back in 2017, and we all know crypto has exploded over the last decade. So, but when it comes to where I'm earning my income, or the income that's supporting my family, especially my mom who's in retirement, I've realized that when it comes to that, I'm looking for safety, and I don't feel as comfortable being as concentrated in income producing vehicles as I am for maybe equity growth. And so I think that was a big kind of starter for me. And as I was thinking about, what does my ideal portfolio look like, I came to I talk about a lot about having an investment thesis. What is your portfolio? What should your portfolio look like in your dream state today or 10 years from now? Let's map that out and then work backwards from that plan. And part of that thesis or that portfolio construction for me, at least when it comes to these type of income deals, is that I don't want to have any more than 5% of my net worth in any one maybe single operator or maybe more specifically a deal. I don't want a deal to go sideways and it hurt so much that it's painful, that it makes me not want to invest again. I think as we all know, investments are inherently risky. And so how do we reduce our risk to it hurting us personally? And so that's when I decided to take a step back. And I slated for Q3 of 2025, the last couple months of trying to figure out, okay, I have a great position now with these 4 funds, but how do I diversify that to be more, instead of 4 funds, maybe it's 10 funds that are all distributing me maybe 10 or 15% of our cash flow needs. And so that is what turned into a full-blown research project. So that's kind of what led me on this path. So, I think the thought here is how do you get a lay of the land? To me, in my eyes, I kept asking myself, okay, well, I know that I have the best opportunity to invest in the best funds if I can pick from a lot of different funds. And so I set out on the objective to interview 50 different operators, and it kind of snowballed, and I ended up coming to over 111 different investing opportunities in these debt and private credit funds across maybe 75 different operators. And the data points that I tracked were everything from fund AUM to when did the fund start? When did the firm start? What is their target returns? Okay, what did they distribute in 2022? What did they do in 2023? What did they do in 2024? How much leverage does the fund have? What is the max leverage the fund is allowed to have as set forth in the PPM docs? What kind of liquidity do I have? Can I get my money out in 90 days, or is it, can I ask for it monthly? What's the fee structure? Is there a profit split? Are you just giving me a flat return and then you take all the upside? What's the collateral? Are you investing in first position loans versus second position loans? How many investors do you have? How many loans do you have in the portfolio? How often do you distribute? I asked all of the questions, and each conversation lasted for about an hour. Some were with founders, and others were with the investor relations team at these kind of institutional shops. And, I think what I started to realize, especially as I'm starting to coach more and more clients about where are there good opportunities to deploy your capital, I've realized that a lot of investors focus a lot on the returns, but that's really meaningless without the context of the leverage that they're taking on, how big the fund is, how many is the fund distributed across 15 big $5 million loans, or are there 3,000 loans in the portfolio with a 300K average loan size each? They're totally different dynamics. And so, I really wanted to understand the whole risk spectrum when it came to each of these individual funds. And that is where things got interesting. And so I'm going to walk through some of these trends. I have 3 big ones that I want to point out. So in my 111 rows in my sheet, I learned, I'm going to say that I'm going to walk through maybe the process of how I started this. So when I first started, I had my initial 20 columns of information that I wanted to ask to make sure that I was asking the same question to every single fund so that I could compare them apples to apples. And, I think as maybe goes with any research project, that the more funds that I talked to, I started to realize, they mentioned a piece of information that I hadn't thought of before. Maybe I'm going to start asking that question moving forward. So as you look at the data sheet, you're going to notice that maybe 75 have, most of the information filled in. And then I have another 40 rows where some of the data is incomplete because I either wasn't able to reach them or get on a second call, or I just hadn't had the time to set up another call after realizing all the questions I still needed to ask. But nonetheless, went through and asked all these questions. So as I started looking at these funds, what I realized was you can get really picky about what it is you're looking for. So, for example, all of these debt funds are basically companies where they collect capital from an investor and they're giving it to a real estate operator to accomplish something. And this could be across the board. This could be from buying land to, they just bought a piece of land and they're looking for a construction loan. It could be that a single family home renter is looking for a rehab loan so they can renovate and fix and flip single family homes. There are firms that specialize in providing loans to only multifamily apartment buildings that specialize in workforce housing. There are funds that specialize in only buying non-performing loans at the bank. There are funds that will only invest in New York. There are funds that invest all across the Southeast. There are funds that invest in a cannabis warehouse facility and specialize on grow facilities because there's an arbitrage because those people can't get financing from the federal government because cannabis is still illegal. And there are funds that focus on just commercial properties. And so I thought that was pretty interesting where, I think 111 funds that I looked into is really a very small portion of all of the funds that are out there. But it really made the point to me that, I can be picky about what it is that I'm interested in or not interested in. And I can keep looking for firms until I find that. I think when I look at my own portfolio, I think when I look at funds like the DLP Capital and the Polaris Cannabis Fund that I'm in, they already have a large portion. And when I say a large portion, let's call it 30 to 40% of the fund is in construction loans. And so to me, as I was going through this list, I was kind of thinking, you know what, I don't need any, it doesn't matter how good the returns are. I don't need another fund that does a lot of construction loans or construction loans at all, because I kind of have that in my portfolio already. And I want to diversify from that risk, especially, where we're at in the macro cycle. And so, I think that is something that I think, I don't know, was big for me. And I think other people should really think about is like when you're investing in these, what is the strategy that you like? What do you think based on the next 5 or 10 years are the biggest risks? Do you think there is a potential for a housing crash? If you do think there is a potential for a housing crash, maybe you find a fund with low leverage, or maybe that doesn't do construction loans. And maybe you only focus on debt funds. Maybe they provide a lower return, but they're only investing or giving lending to stabilized assets. So all in all, I think the point here I'm trying to make is that there are a lot of funds that pretty much do the same type of lending, but they all have their very own unique, nuanced strategy. And there is there is room to kind of pick and choose what you want to have in your portfolio. Okay, so that wraps up number one. So number two was, I found it fascinating how, I found firms that were generating anywhere between 6% and I would call it 16. Some funds even distributed 19 or 20%. And given all of the deals that I've looked at, it feels pretty safe to earn somewhere between an 8 to 12% return, and it be relatively, I think that's a good risk-adjusted return. I think once I started looking at funds that were above 12%, you could tell they had a lot more hair on them. They had a lot more leverage, or they were taking second position loans, or they were doing much larger loans, and that kind of just made me uncomfortable. But I think all in all, when you look at the 20 plus funds that you could earn at least a 10% return, that 10% return is not created equal. There are some funds that would offer you a fixed 10% return. Basically, you're just giving their company a loan and then they're reloaning it. And then there are ones that had profit splits, where they either had an 80-20 profit split and they were highly incentivized to make that number go up. There were funds that wouldn't offer you any transparency into the fund. They had no loan tape, which is this Google sheet of paper that lists every single loan that they have out. When did that loan start? How big is the loan balance? What is the interest rate on that loan? What is the term on that loan? Basically just a sheet that explains, the inside of their business. There were so many funds that would not or did not have that readily available to share. And then there are, on the other side of the spectrum, funds that issued 10% returns that had audited financials and that would give you they already had the loan tape ready and prepped in a data room that you could check out. So that was a big, takeaway. There were tons of funds. I would say half of the funds I looked at were structured as a REIT. And so you would earn 10% and your that income would only be taxed at 20% long-term capital gains. And then there were a lot of funds that issued 10% returns where you'd be taxed at ordinary income, which could be anywhere between 30 and 50%, depending on what state you live in. And so also very important to keep in mind, there were firms that gave a 10% return that were in first position loans, meaning if anything went sideways, they could take the home as collateral. And there were many funds that gave you a 10% return, and they were doing second position loans where they didn't have any direct collateral to go after. Some firms were small, $5 million in their fund. They maybe had 11 or 12 loans in it. And then there were $5 billion funds, like the DLP Capitals of the world. And so I think, what's mind-blowing to me is that, yes, a lot of the stuff takes work to dig into, but man, there is, for just a little bit of work or meeting with someone like me who's done the work and can point you in the right direction about where to go, it's just crazy to me how just the different levels of risk, these different funds have to earn the same 10% return. So again, I think just the biggest takeaway here that I keep coming back to and want to hammer home is that the more deals that you look at, the more that you understand what is average and what's exceptional. What is if you could have all the things be true, you would want to earn a 10% return, first position loan with audited financials that's been around for a decade, that's went through multiple down cycles, that, that have over, a couple hundred investors, that have their portfolio spread across 100 plus loans, right? Those would be the ideals that you would want in these funds. And if you just look at enough deals, there are at least 5 or 10 that have all of that criteria. So I wanted to mention that if you are in the middle of deploying capital and you want to make sure you're putting it in the right place and taking on the least amount of risk, like take a look at a bunch of different funds, or set up a call with me, and maybe you're a good fit for the Cash Flow Academy, and I can walk you through and help you figure out where to deploy your next 50 or 100K and make sure you're getting the best risk adjusted return. There's just so much out there, and it really pays to seeing all of them. And then I think maybe the third takeaway that I would share here is that it is wild to see how in some funds the returns would swing wildly. I think when I think of a debt fund, or at least where I want to be investing, is a place where I know I'm going to generate a consistent return above 9%. I'm looking for a blended 10% return on my invested capital when it comes to debt funds. And, there are some funds that I looked at where, in 2022, they were generating a 7.8% return. And then all of a sudden in 2024, they're generating an 11% return. And I've also seen the opposite. When money was really cheap in 2021 and 2022, there are funds where, the funds who operate on a lot of leverage, maybe like the Dwight Mortgage Trust was an example. The Dwight Mortgage Trust is a fund that focuses on providing bridge financing to basically giving financing to real estate operators who want to buy a building and make improvements that already will qualify for a housing and urban development loan, a HUD loan, a federal loan, and they have 500% leverage, up to 500% leverage allowed in their fund. On average, right now, it's between 2 and 4x. So to set the stage here, that's like you're investing $100,000 into their fund, and then they're going and getting $300,000 from the bank and investing $400,000 into a loan. They've never lost a loan since they've been around in 2014. As far as, when I talked to them. And so, when they started in 2022, their returns were 15.6% for that year. And as money got more expensive, their returns went down. So in 2024, their returns were 12.4%. So it went from 15.6 to 13.4 to 12.4. And so, I think it'll be relatively stable here, but it was fascinating to see how the different economic environments adjust the returns and just maybe how inconsistent some of these other funds were. I looked at a fund called the BRC Commercial Fund, and in 2022 they had a 7.1% return. In 2023 they had an 8.3% return, and then in 2024 they had an 11.1% return. And so I think in general, someone, if you're listening in and you're hearing this, you might say, oh, they're increasing their returns. I think for me, when I look at a fund like that, that's less exciting to me. I want to be in a fund that's stable, because if it can go up that much, my thesis is it can also go down that much. And if I'm relying on the income, I want it to be consistent. So there are definitely tons of different funds out there. I think I've just scratched the surface of the different vehicles. I've looked up maybe 111 deals across 75 different operators, but there is a lot out there, and it pays to do some research. So if you're in the middle of deploying capital, you're interested in debt funds at all, and you want to kind of take advantage of everything that I've learned looking at all of these, I definitely encourage you to sign up for our email newsletter and book a call on the following page. You'll get access to at least 25 different private deals that you can invest in today. And I update that every Friday with 3 new deals that we come across from our network and our own deal flow search process. So if that's interesting to you, I would recommend going to passiveinvestingstarterkit.com and you can sign up there and book a call. Again, that is passiveinvestingstarterkit.com. Okay, guys, that was my kind of synopsis of the deal research project. Interviewing all the 75 plus different debt fund operators. If you liked this, if you got value out of this is one of my first solo episodes. So if you have any feedback or suggestions, or if you just enjoyed listening in, I would really appreciate you reaching out on LinkedIn or email and let me know. Other than that, this is the Passive Income Playbook, part of the Best Ever CRE Show. We drop new episodes every Thursday, so be sure to tune in each week for more insights and conversations around LP investing. And if you enjoyed today's episode, please subscribe. Leave us a review. It really just helps us reach more investors like you. And with that, thank you for tuning in, and I will see you next week for another episode of the Passive Income Playbook.